Hello everyone! Let's start off by reviewing our long call option. First, we make money if the stock goes up, so we're bullish on the trade. Our max profit is technically infinite because a stock can always go higher, while our max loss is capped at what we paid for the option plus any commissions we paid to execute the trade. Because we purchased this option, time decay is working against us, affecting the options the closer they get to expiration. Because an increase in implied volatility increases option prices, we want implied volatility to increase, and we get hurt when it decreases. Our break-even point for a call is going to be the strike price plus the cost of the option. If the stock fails to reach this break-even point, we lose money on the trade. If it goes over the break-even point, then the trade is profitable. Calls that are further out of the money will end up costing less and have a higher return on capital, but they have a lower probability of success. Calls that are deeper in the money will end up costing more, have a lower return on capital, but have a higher probability of success. We do not recommend this strategy often, as buying long calls is not a sustainable strategy that will produce consistent profits over time. However, if you do decide to buy calls, going out long-term is better, as it will be less affected by time decay. Now that we understand call options, let's consider buying put options, which has all the same properties of buying a call option, only we would be taking a bearish position in the stock and hoping the stock trades down. Many new traders think calls and puts are opposites of each other, which could not be further from the truth, as they're almost exactly the same. In fact, with the use of stock, you can synthetically turn a call into a put and a put into a call. That's a lesson for another day. Just understand that buying a call and buying a put share all the same properties, other than their desired direction. The only other difference, and it's a small difference, is the max profit on a call is infinite because numbers can increase forever, whereas a put gets stopped out when the stock goes to zero. Of course, this is a minor point, because stocks we trade never go to infinity or to zero. They both have time decay working against them. The prices of both increase when implied volatility goes up and decrease when implied volatility goes down. Because we're seeking a bearish play when we buy puts, the break-even is calculated by strike price minus the option price. If the stock trades below the break-even point on expiration, then we will profit. If it finishes above this break-even point, then we take a loss. Puts that are further out of the money will end up costing less and have a higher return on capital, but they have a lower probability of success. Puts that are deeper in the money will end up costing more, have a lower return on capital, but have a higher probability of success. Finally, before I let you go for this lesson, I want to touch very quickly on long options that you own on expiration Friday. If the option is out of the money, you do not have to do anything. You don't have to close it. You simply just let it expire worthless and it will disappear from your account. You'll just be out the money the option cost. If, however, the option is in the money, you do have a couple of choices. First, you could not do anything, as your investment bank will exercise any options you have that are in the money for you. So, for example, if you own one 50-strike price call option contract that's expiring, and the stock is trading any price over $50, your investment bank is going to automatically buy 100 shares of that stock for you at a price of $50, which is a good deal. If the stock is trading 52 and you can buy it for only 50, you want to take advantage of that. Likewise, if we owned one 50-strike price put option that was in the money at a price less than $50, your investment bank would automatically sell 100 shares of stock on your behalf. Of course, if we don't want to own the stock, and in most situations option traders don't, we simply close our option position before the market closes on expiration Friday. We do this by selling that option we're long back out. So if we're long one call, we sell that one call. If we're long one put, we sell one put. Instead of taking the stock and tying up all that capital, we're simply going to convert that option back into cash before it gets exercised. Let's run through an example. If we own a 150 strike price call that is expiring and the stock is trading $52, we could simply do nothing and let that call convert into 100 shares of stock. This will cost us $5,000. We could then go out and sell that stock for the price of $52 times the 100 shares, and we would get $5,200 back into our account. So for this transaction, we had a net gain of $200. Our other alternative is to sell the option out before the market closes on expiration Friday. We know options expiring are only worth their intrinsic value, and a 50 strike price call when the stock is trading 52 has $2 of intrinsic value. Here, we could sell this option for $2 times the number of shares this contract controls, 100, for a total gain of $200. So as you can see, it doesn't matter which method we use. It's going to be the same P&L either way. It really just depends if you want to take control of the stock or not. Okay, everyone, that's it for the long option strategy. In the next section, we're going to jump right into talk about the short option strategy. Be sure to take the quiz below, and I will see you in the next lesson.